This is Michael Burke, and today we'll be discussing a new Strategy Concepts white paper article on developing a key reversal strategy on case bars. Strategy Concepts is a collection of articles and resources designed to demonstrate the process of developing different types of strategies, to showcase different strategy testing approaches, and to explore different types of trading ideas, both entries and exits. And I'll be creating one or two of these articles each month, and I hope, my goal is that these ideas will spark conversations within our community. Keep in mind that the following presentation is for educational purposes only. All of the symbols and trading ideas discussed are for educational purposes and are not recommendations. Active trading is not suitable for everyone. Past historical performance does not guarantee future results. And you can find additional disclosure information on the TradeStation website. This is Strategy Concepts, Case Key Reversal. So today our agenda is to look at a key reversal idea using case bars. And I like case bars for a number of different reasons. One is that it is a price-based charting style that does not create phantom bars. A strategy can actually trade on every bar that the case bars build, which is important. And case bars, just like all of the other price-based charting styles, reduce noise so that we're looking at just pure price movement and we don't get faked out and we don't get stressed about market making, all of these gyrations throughout the day. We can just focus on pure price movement, which is, I think, a great way for traders to look at the markets. So we're going to talk about some of the nuances of this strategy. Many of you have seen me do or heard me do the key reversal concept before. So it's going to be familiar with you. I'm going to add a few twists here to this concept. But the goal here is really to show you a way of looking at the key reversal strategy on a case bar and how we would backtest that. And so that's really the goal here. So just so we're all on the same page, let's just talk about the key reversal pattern. So the key reversal pattern is a simple two-bar pattern that can help us identify short-term reversals of a trend. Think of it this way: a key reversal up. It starts when there's a downtrend, and we hit a low that is a significant low. Maybe it's the lowest low of 8 bars, it's the lowest low of 13 bars, it's the lowest low of 21 bars, but it's a significant low. And on that same bar, the close of that significant low bar closes higher than the close of the previous bar. So if you think about it in trading terms, right, there are sellers in the market and they're driving the market lower. But at some point, the buyers take control of the market and bring the market back to where it closes above the close of the previous day. A key reversal down is just the opposite. We have buyers in the market driving the market higher. We hit a new significant high, but then sellers come in and drive the market down, and the close of that same significant high closes lower than the close of the previous bar. So that's the key reversal pattern. We're going to apply that concept to a case bar. A case bar is, as I said earlier, is a type of charting style that's driven by price movement. And we set a true range value that we want for our case bar. And so if I set the case bar value to 1, that means wherever the bar opens, as soon as it expands to 1 point, then it builds another bar. So every bar is going to equal about 1 point. It could be a little bit different because of the way that we parse the tick data or the minute data, but generally each bar is about 1 point in size, 1 point in true range. So as it's building, it's not only looking at the high and low of this bar where the price movement is action, but it's also looking at the close of the previous bar. So it takes the close of the previous bar and the price action on the current bar, and once it reaches 1 point, that bar is complete, it closes, and a new bar starts. So that's that true range concept, looking back at the close of the previous bar. Why I think this works for key reversals is that very often when I'm looking at a time-based chart on key reversals, you end up sometimes at the top or the bottom of a move with these really large bars with big tails. And these can sometimes be outside bars. And so it's difficult in that environment when you have this huge outside bar, even if the close does close below the low of the previous bar, above the close of the previous bar, depending on which direction we're going here. It's not such a clean signal because of that huge outside bar that is overshadowing the actual key reversal signal. So if we use a case bar, then the hurdle for it closing below or above the close of the previous bar is always the same hurdle. It's whatever the case bar value is for the bar. So if it's 1 point or 3 points or 8 points, whatever it is, it's consistent, and you don't have that outside bar overshadowing the actual key reversal signal. I think it is a great way of looking at key reversals so that each key reversal is a consistent signal. So part of this package is an indicator that plots a arrow everywhere the key reversal condition is true, so we can visually backtest this. So there's no strategy on the chart here. This is just an indicator that is pointing out where all of the different key reversals are. And then we're going to build a strategy around all of those different points. And you can see that key reversals are pretty good at picking those bottoms where you have a significant low and then a higher close. And again, this is a case bar. So this is an 8-point case bar on the E-mini future. So each of these bars are approximately the same size. Notice here, we have here on the right, we have this significant low, but we did not get an arrow. And that happens sometimes. Sometimes you get a significant low, but the close isn't greater than the close of the previous bar. But then the market does continue higher. This I would consider to be more of a pivot than a key reversal. And so one of the things that I wanted to add to this strategy was the concept of a pivot reversal as a secondary signal that can be taken in this strategy. So not only does this strategy take key reversal trades, but it will also take these pivot trades. And right now, this indicator will also demonstrate those pivot points with an arrow as well. I just have that turned off. It's a switch. So in this indicator that's drawing these arrows, there's an input switch that says draw arrows on the pivot points as well, and I'll show you that. And so you can decide whether or not you want to include or not include that pivot point condition within the strategy. So that's one of the things that I do quite a bit in my strategies, is that I will build in rules. So it's funny, I'll get an idea for a strategy, and then as I'm writing the strategy, I think, oh, it would be cool if this strategy also bought in this way, with a different set of conditions. And so instead of just including it as part of the strategy, I'll create an input switch, which says, okay, if this input switch is true, then that set of rules to enter the strategy, it can enter a strategy using those rules. Otherwise, it doesn't. So it gives me the ability to turn on those ideas on and off. So I might have 2 or 3 different ideas in a strategy, and I'll have switches in the inputs that turn on or off those different ideas, so I can trade different combinations or test different combinations of ideas that are similar but are also built into the strategy. And you can do that with exits as well. So this is the key reversal strategy here, and you can see, just like any strategy, it's going to generate trades long or short based on that key reversal condition. You'll notice that you'll always get an arrow, and then it'll generate the order. It's important to remember here that the inputs for the indicator must match up with the inputs for the strategy, so that the arrows are drawing at appropriate places based on the same rules, the exact same rules that the strategy has. So it's always important to look at the inputs for the strategy, look at the inputs for the indicator, and make sure all the input switches, all the values for look back are all the same. And that's true for any strategy that you might be testing. So this is what we were talking about, whether or not we want to use that pivot condition as part of our testing. So there's a switch inside of the strategy, which I'll show you. When it's false, it's not using the pivot. The strategy will only enter with key reversals, or you can turn on the pivot and it will trade with both key reversals and pivots. So both of them can generate trades in that case. It's just a matter of, over the years, I have, looking at all of these charts with the key reversal pattern, I have noticed that it sometimes misses some significant highs or lows because it just didn't hit that hurdle. The close just didn't close a little bit higher than the close of the previous bar, or on the other side, it didn't quite close lower than the previous bar, but it still was a good signal. And you're able to identify that simply by waiting one bar and looking to see if the close of the next bar crosses over that threshold. And if it does, you've got a pivot instead of a key reversal, and then we'll make that trade, and we don't miss it. Okay, so here's our testing environment. We are going to be looking at the E-mini S&P 500 futures contract. That's the normal contract. It has a point value of 50. We'll be looking at 3 months of the most recent data, and we'll be testing a case bar with different case bar interval values. When you first come up with an idea, very often the trick is to figure out what is the best environment for this strategy. And in this case, I know I want to use a case bar, but I want to know, first of all, what case bar interval would be the best, not the best necessarily, but would be appropriate for this strategy, for this symbol during this mode of the market right now in this current 3 months. And so what I'll do is I will test the strategy by changing that case bar interval, both with the key reversal condition by itself and with the key reversal condition with the pivot on. So this is done manually for the most part, right? I have to put the strategy on the chart. I have to change the interval in the chart. I have to look at the performance, maybe do an optimization on the look back length for the highest high or lowest low, save that optimization report, go to the next test and the next test. So in this case, I did 8 tests. I looked at the case bar intervals at 5, 8, 13, and 21. I looked at the performance with the strategy with the pivot on and with the pivot off. So there are 8 tests there, and I'll show you the results of those 8 tests. And I did that because I wanted to have a initial environment where I can take that information and then build an actual trading strategy around that. And so the way that I tested it is that the way I've always tested these kinds of ideas is with just a statistical test. In other words, it takes a key reversal trade and then I just close the trade 3 bars later. All I'm looking for here is to see what is the strength of that signal. Did the market move higher if it was a key reversal up, or did the market move lower if it's a key reversal down, and what percentage of the time did it move in my direction over those 3 bars? So very statistical way of looking at this idea initially, and then once I have the results of that test, that phase 1 testing, which is just using time exits, then I'll have a guideline where I can start phase 2 testing, where I will actually plug in a bracket, profit target, and stop loss. On a counter trending strategy like this, I would expect the strategy to be right anywhere from 55 to 60% of the time. And so if that's my winning percentage, then all I need is a risk-reward ratio of 1 to 1 or better to have a positive expectation of profit, and that's what I'm looking for here. So let me show you the phase 1 testing and then how we derived the environment for the phase 2 testing. So this is phase 1 testing. So I have to tell you, this was done manually. It's 8 tests where I change the interval, and then I look at the strategy with the key reversal on. So I look at the strategy with the pivot on or with the pivot off. So this is a 3 bars to exit test. We're looking for the highest high and lowest low over these 19 scenarios from 3 to 21. So I optimize the strategy in each of these scenarios for that look back length. So we're looking at a 3 bar significant high and low, a 4 bar significant high and low, 5 bar, so on, all the way up to 21. So there's 19 tests in each of these 8 runs that we did. So here you can see we did long 5, long 8, long 13, long 21. That's the other thing I haven't mentioned yet, in that we are only testing this strategy long. In this environment where the market is relentlessly moving up, the short trades just did not make any sense. So I looked at the short trades, and there was no way to create what I would consider a robust strategy using short key reversals in this current environment. Now that could change. The market is certainly going to consolidate for some period of time where the short trades will be more appropriate, or the market could start trending down for some period of time where the short trades will do better. But right now, we're only looking at the long trades in this particular article, in this particular presentation. The 8 scenarios are long 5, long 8, long 13, and long 21. And I'm optimizing from 3 to 21, the highest high and lowest low look back. So the top 5% profitable results in those 19 scenarios are here. So you can see when the Kase bar was a 5-point interval, the strategy was only right 50% of the time in the top 5% profitable results in the optimization report. Long 8 was 63, long 13 was 46, and long 21 was 60. So a little bit of inconsistency there. This is without the pivot condition. With the pivot condition, it's pretty much the same. Long 5 was 52, long 8 was 58, long 13 was 48, and long 21 was 63%. So the top 5 optimized results with a 21-point Kase bar was right 63% of the time. All right, so the number of positive tests in the 19-run scenario. So this is a robustness test. So when you run an optimization, how many tests in that optimization were profitable or significantly profitable? So in long 5, there was only 7 of the 19. All 19 were positive in the long 8. 14 were positive here. Only 6 were positive in the long 21. So only 6 were positive, but those 6 were right 60% of the time. So that's a little incongruent in that I don't want to only have 6 of the 19 tests be profitable, even though they're right 60% of the time. So that's a little odd there, and anything that's a little odd is a red flag in the strategy trading world. And you can see the same thing here with the pivot on. More of the tests were positive. So with a Kase bar of 5, 18 of the 19 tests were positive, not significantly positive. Some of them were just a few $100s positive, but again, we're not measuring by dollars here. This is purely statistical, 3 bars from the exit. But I want to know how many of them are positive or negative. So that's the idea. So then one of the things we talk about in this sessions on Wednesday is the RENA score. Well, I don't have the RENA score to compare strategy scenarios in the optimization report, but I do have the TS index, which is very similar in the calculation. And so I want to have a really good TS index score, and I can compare all of the scenarios based on that index score, and that no pivot condition using an 8-point Kase bar was the best index score of all of them. So after running all of these, the 2 scenarios out of the 8 that seem promising that we could build a strategy based on are the 8-point Kase bars, either with or without the pivot condition. And the one without the pivot condition seemed a little bit better. And again, I want to point out that if I ran this a month from now, the market could be very different. And we might be looking at developing a strategy on one of these other scenarios. And that is very common in this type of strategy development. Strategy traders are always looking at the market environment, and they're always looking at trading different time frames. I'm a believer in looking at the most recent data because that's what I'm going to be trading. Other strategy traders look at longer term periods of time, maybe a year or 2 of this data, to see what the long-term robustness or stability is of an idea. So there's lots of different ways to approach this. But in this case, for building a strategy now, to start trading now, I want to look at the most recent data, and I want to look at the scenario of the strategy that is doing the best right now. And that's the goal of this. One really important thing here. So as we go through the process of strategy development, it's really important to factor in all the costs. you can imagine that if I'm doing this statistical study and I'm not factoring in commissions and slippage, that these results will be very different and probably look much better than they look right here. But this scenario, these 8 tests, include a factoring in of commissions. We're trading, actually this test was trading 2 contracts. I was factoring in the commissions for 2 contracts and the slippage for 2 contracts based on the fact that this strategy generates market orders, stop market orders. So we have to factor in commissions and slippage. So the results you're seeing here are actually the results with that factored in. So that's really important to think about. So in the properties setting of the strategy, there is a box in the upper left where you can set the costs for the strategy. And typically when I'm just testing an idea initially, or I'm just experimenting, I might not set those commissions just because it's not necessary in that early stage. But when you get to this stage of testing an idea, where you're actually going to start plugging in profit targets and stop losses, you have to calculate and you have to factor in the cost to trade that strategy. So phase 2 was plugging in a profit target and stop loss. So we used an 8-point case bar, trading 2 contracts, and we plugged in different values for profit target and stop loss. So what you didn't see on this screen was the fact that I had gone through the performance report for all of these scenarios, and I'm looking at for a couple of different things. I'm looking for things like what is the maximum excursion for all of these trades. So there's a graph in the performance report that shows you the maximum excursion. Excursion is the biggest drawdown for each trade and where it ended up, whether it was profitable or not. And so by looking at all of the different performance reports for that maximum excursion, that maximum drawdown excursion, I was able to determine that the strategy should probably have somewhere between a $500 profit target or stop loss and a $2,000 profit target or stop loss. So now that we know the environment that we want to trade in, an 8-point case bar, I can go and set up my chart and then optimize the profit target and stop loss and see what different combinations generate what kind of profitability and percent profitable in the trades. And so this is the top of the optimization report. There were 49 tests that we did here. So we optimized from 500 to 2,000 in increments of $250. And when we go to TradeStation, we'll actually go through this process in TradeStation in a minute. But I wanted to show you this report first and what I focused on. So once we did that optimization, 49 tests, I'm looking for scenarios where that match this idea. So I'm looking for scenarios that are profitable 55 to 60% of the time. So here's our percent profitable column, and you can see there are a number of different scenarios that are greater than 55%. We'll talk about some of these higher percentages and lower percentages in a second. And I want to make sure that we have enough trades. So we have to have at least 30 trades. Here we're having about 170 trades over 3 months. So this is a pretty active strategy. If you think about it, you're going to make 170 trades over the next 3 months. That's about 50 trades a month. That's a couple of trades a day. So it's a pretty active strategy. So I'm not too concerned about net profit. Obviously, we want to make money over that period of time, but that's not the goal here. The goal here is to find something stable and robust that we can test going forward. So I want a percent profitable between 55 and 60%, and I want my risk-reward ratio to be 1-to-1 or better. Here we have a risk-reward ratio of 1250 to 1,000, so that's better than 1-to-1, and I have a 56% winning trade, which means my expectation of profit is pretty good. And in fact, my expectation of profit on each trade is right here, $207. So for every trade I make, some will be winning trades, some will be losing trades, but on average, over those 162 trades, I made $207 per trade. So that's my expectation of profit. I also want to do a gut check over here of the maximum intraday drawdown. So that's $9,000, and so I'm going to compare that to my net profit. I don't want that to really be more than about 20% or of this. It's a little higher than that. It's about a third, but still in the early stages here. We're still lining everything up. So that's still not bad right there. And then here you can see the TS index on the far right. This is actually sorted by the TS index, and the test that I'm highlighting here, that number 3 test, it has a high TS index versus the other 49 there. So it's third out of 49. So what's interesting about looking at an optimization report like this is you get to feel the nature of how strategies work. For example, notice that when the percent profitable is higher, here it's 60 and 60.24 and 59.35, notice that the risk-reward ratio can be less, right? It can be 1-to-1 because we're now making 60% winning trades. It's 1-to-1. It doesn't make as much money as this, but you can see that when you have a higher percentage here, you have a 1-to-1 risk ratio. And as this gets higher, notice the next one up here, 72%. Notice the risk-reward ratio now is negative. So I'm only making $12.50 and risking $2,000. But because I have more room for my trade to work, I have a higher percentage. So that's the nature of having a higher percent profitable. You're giving it more room and you're taking less profits. So this has to be higher in order for that to generate a positive expectation of profit, which you see over here. On the other side of that, if you have a low percentage profitable, then the risk-reward ratio has to be much more in your favor. So in this case, I'm taking $1,250 of profit, and I'm cutting my losses very short with a $500 stop loss, but I'm only right 42% of the time. Now that has the best risk-reward ratio because I'm not risking very much money, but I'm only right 42% of the time. So each of these has a positive expectation of profit, but the risk-reward ratio is tied to the percent profitable. If you want to have less risk, you're going to have fewer winning trades. You just have to balance what kind of trader are you? Do you want to trade and have fewer winning trades, or are you the type of trader that wants to have more winning trades? But in this type of a strategy, the nature of a key reversal is that it should be right 55 to 60% of the time. So that's what I'm looking for. I'm looking for these percentages, and I'm going to match my risk-reward ratio and see if I can generate a positive expectation of profit. If I can, and the intraday drawdown risk is reasonable, then I have a strategy. That's the idea. Oh, okay. So in that Edit Strategies dialog, there's a button on the right that is Properties. When you click on that Properties dialog, this is the dialog that comes up. Here you can see I've set my trade size to 2 contracts, but here in the upper left is where we set our slippage and commissions. So here, since I'm trading futures, the commission is $1.50 per contract. And so we're trading 2 contracts, so that's $3 in, $3 out. That's being factored into the performance. And then I'm factoring in even a higher amount, $12.50 per contract for slippage. Now the point value on the E-mini is $50 and it trades in 25-cent increments. So a 1 tick move in the E-mini is $12.50. Times 2 contracts would be $25 per trade. So I am factoring in $25 in trade in slippage in the performance that we just looked at. So it's really important to factor that in, because a lot of times you'll look at a strategy and it looks great, but it makes a lot of trades, and when you factor in the commissions and slippage, the strategy doesn't make money. So you've got to test it with the costs to trade the strategy included. All right, let's go to TradeStation. So this is the workspace that is in that zip file. There are 4 charts. On the right are the strategy is set up to trade short only, and on the left the strategy is set up to trade long only. The top 2 charts are not using the pivot condition, and the bottom 2 charts are using the pivot condition. Also in the chart is the strategy equity curve, which allows you to see how the strategy is doing bar by bar. On the left, we're using 8-point case bars, using minute intervals to build those case bars. And on the right, those are also 8-point case bars. And you can see that the short trades just in its, this is, by the way, this is in the testing mode. We're only using 3 bars here. So we are entering and exiting after 3 bars. We're not using profit target and stop loss yet. I'll show you that here in a second. But this is just the pure testing mode. This is phase 1 testing, where, let me right click and go to studies and edit strategies. So this is phase 1 testing. We're only using the time exit. So you notice the time exits are on here. The profit target and stop loss, those are off. And we're using the key reversal. So notice that the key reversal here, the buy is on, the sell short is off. So that's why we're only testing long using that setting right there. So this setting allows you to turn on or off the short trades or use the short trades as an exit only. In this case, we're just testing the longs. The key reversal short is off. We're not going short here. If I click on customize, here you can see that we're using a 8-bar look back for our highest high and lowest low. So this is one of the values that we optimized. And so phase 1 testing was optimizing that look back from 3 to 21. I'm going to click OK and OK again. 19 tests. There we go. And so now I can right click and go to data and strategy optimization report. And there's the 19 tests. Now this is phase 1 testing. So all I'm looking for here really is how many of the tests were profitable. In this case, all of the tests were profitable. You can see that. You can see the winning percentages here. And what I did is I sorted by the TS index. And then we just look at the top 5. And so I will look at the top 5 and average those as the percent profitable. What I do in this phase is I'll right click and I'll save this report to a CSV file. So I'll call this, I might call this case 8 and save that. And now that is a text file that I can import into Excel. And so I'll do this 8 times, import all of those text files into Excel, and then I can do that analysis, which was the phase 1 testing. So that's the idea. So once we have phase 1 testing done, let's go back to that for just a quick second. Data and strategy optimization report. So 8, you'll notice 8 was the best test there. So that's what we're going to explore, is a look back of 8 bars on an 8-point case bar. I'm going to right click and I'm going to go to data and performance report. So one of the things I want to look at here in the performance report is a couple of different metrics. So one of the metrics that I want to look at is, obviously, are there enough trades? 148 trades is good. I want to look at consecutive losing trades. So 6 consecutive losing trades is quite a bit, but again, this is just phase 1 testing. But what I really want to do is I want to go to the trade graphs. And I want to look at a trade graph called maximum adverse excursion. I mentioned this earlier. This shows the drawdown of each of those trades in the strategy, each of those 150 trades or so. A red triangle is a losing trade, and a green triangle is a winning trade, but what's important is the bottom. This is the drawdown for each of those trades. So if I were to have a stop loss at $1,000, for example, each of these trades on this side of $1,000 would get stopped out at 1,000. So all of these losses, all these red triangles, would get stopped out at $1,000. This triangle way out here, which had a drawdown of about $3,300, would actually, and it lost about $3,300 if you read across. This is the P&L. So this trade lost $3,300. It drew down $3,300. But if I had a stop loss in place at 1,000, then this would only have lost $1,000. It wouldn't have lost $3,300. That'd be great. But take a look at a trade down here. This is a red trade that lost maybe $100, but it drew down $1,500. If I have a $1,000 stop loss in place, that trade right there, which only lost $100, is now going to lose $1,000 because it would have gotten stopped out as it was drawing down. So there's a trade-off here, right? Some of these trades do better with a stop loss. Some of these trades do worse with a stop loss. What is that balance? And so that's what we want to test. We want to optimize the profit target and stop loss and see where that balance is in comparison to our percent profitable, right? That's the goal. And that's what phase one testing does for me. It gives me the ability to look at this chart and figure out what are the range of values that I need for my bracket. So I'm going to right click and I'm going to go to Studies and Edit Strategy. And so for phase two, I'm going to turn off phase one testing. I'm going to turn off the time exit. I'm going to click Status and turn that off. And then I'm going to turn on the profit target, status on, and I'm going to optimize these. So we're going to optimize them at the same time. So I'm going to select the profit target first, click Customize, select the amount, and optimize. There's my range of values, $500 to $2,000 and $250 increments. I don't believe in optimizing at a fine resolution. I know people who will do this, and they'll optimize in increments of $10 or $1. And that just doesn't make sense. It needs to be robust across a higher increment value instead of such a refined value. That doesn't make much sense. At least it doesn't make much sense to me. So here I'm going to click OK. By the way, sometimes you get this message that says the optimized values you've entered are too large. That doesn't really apply here because these are dollars. These aren't look back links and bars. So this is a max bars back error that is not appropriate if you're using dollars. So you can ignore that. And then I'll click OK. We'll go to the stop loss, click Customize. We'll optimize this from $500 to $2,000 again in $250 increments. Click OK. That's 49 tests. That's what we talked about before. We'll optimize that. And you can see how fast that comes back. So then I can right click and go to Data, and here's the optimization report that we looked at in the PowerPoint. Notice that almost all of the tests are profitable except for a few here at the bottom. We definitely want to look at those inputs and kind of see whether or not that is consistent as we move up the list. So you can see that low profit targets and stop losses typically don't do as well. So that's interesting to know. And then as we move up, we want to see what the best results are. And we want to see that they're also in a family of best results. Notice there's a couple of outliers here with these $750 stop loss amounts. So those are the kinds of things that kind of we would ignore those because they're just not really in the main group of parameters that are somewhere between $1,200 and $1,500. Over here on the far right is the TS index. I'm going to double click on that and sort by that. That brings the best risk reward scores to the top. And I'm going to pick something that has a 55 to 60% winning percentage. Here's one that's 55. It has a better than 1-to-1 risk reward ratio. I have a positive expectation of profits. So I'm going to right click on that row and apply that test to the chart. So now that test is in the chart. And I can right click on the chart and go to the performance report, and I can look at the equity curve for that. So and that's the idea. So that's phase one, phase two testing, and then what comes next, right? What do we do after this? Okay, before we talk about what comes next, there's a couple of housekeeping things I want to get out of the way first. So here I'm going to again right click in the chart, and I'm going to go to Studies and Edit Strategies. And one of the things that I want to look at here is the inputs for some of the strategy components that make up this strategy. So let's start with the key reversal strategy that comes with this article, this white paper. I'm going to click on Customize. So here in the inputs for the strategy, I've broken up the look back length for the highest higher, lowest low as two inputs. So there's a key reversal up strength and a key reversal down strength. Key reversal up strength is used for long trades. Key reversal down strength is used for short trades. And here are the two inputs that allow me to turn on the pivot condition. So right now it's set to false, which means that it is only trading the key reversal. But if I set this to true, then the strategy will not only trade key reversals, but it'll also trade any pivot condition that occurs in the chart. So I'm not going to turn that on now. In fact, I'm going to cancel this and click close, because this chart in the bottom has the pivot turned on. So here you can see there are 4 trades in this chart, and there are more trades, 5 trades in this chart, because this was a pivot trade, not a key reversal trade. And so that's the idea. By turning on that switch, if I right click in this chart and go to studies and edit strategies, and I look at the inputs now for the strategy, you'll notice that that's set to true. So the pivot condition is set on in this chart, off in this chart. That's the idea. And I can test it both ways. That's the goal. The time exit, simply for phase 1 testing, has an input for the bar to exit on. So in other words, once I'm in a trade, the strategy engine will count this number of bars and then exit. So very statistical, not really looking at profit target and stop losses and drawdowns here. All we're really looking at to see is the strength of that signal good. What is the percentage of winning trades at some look back length at this interval, and look at that percentage, look at that statistical performance. And then of course we can derive other information to help us move on to phase 2 testing. But bars to exit on, that's phase 1 testing stuff. And here I can turn those on and off as needed. And then the profit target and stop loss, these are built-in components. One of the things I haven't mentioned yet is that this is a custom strategy that I'm providing with the paper. The other 4 strategy components here are built into TradeStation. I'm just using tools that automatically come with TradeStation. These aren't custom tools at all. I can go to, let me close this. I can right click in a chart. I can go to studies and add strategy. And here under strategy components are those profit target and stop loss components. And I added those into the chart. Also, here's the time exit bars, long exit and short exit. So what we're using here is a custom entry strategy, and we're using components to exit. And of course, phase 3 testing would involve taking those exits to another level, maybe looking at some technical ways of exiting and other tools to make those exits more efficient. And that would be something that we could do in next steps, right? From as we continue to work with this strategy. So let me go to studies and edit strategies. And here I want to look at the inputs for, let's say, the profit target. Now the inputs work the same way for both of those, so I'm just going to pick profit target here. I have to turn it on in order to get to the inputs. Now I can click customize. And so position basis true means that in this case, the profit target amount, if it's the stop loss, it's the stop loss amount, is set in dollars for the entire position regardless of the trade size. So whether I'm trading 1 contract or 5 contracts, once this strategy hits $1,250 in profit for the entire position, it's going to exit me. Now if I set this to false, it changes the behavior of the profit target. Now it is simply looking at the amount for 1 contract. So what is the dollar amount for 1 contract? So this way I can say, for example, if I'm trading Apple, I can set this to false and I can say I want a 10-point stop. So based on 1 share, if the market moves 10 points or $10 because it's 1 share, then it's going to exit. If I'm trading futures, it's a little trickier because I have to multiply the points that I want to get out times whatever the dollar value of that contract is. So that's a little trickier. There's a reserve word in easy language called big point value that we can use to solve that. So I'm just going to show you this here as an example, just in case you want to try this. If I say false, remember we're trading the E-mini future here. So if I wanted a 10-point stop, I'd have to multiply that times big point value. So I type in a formula here, 10 points times big point value. Now the problem is I can't optimize that, right? Because you can't optimize a formula like that, but that's the idea. That would become my stop loss. So for futures, I like to use dollars. It just makes it so much simpler, and that's the default here, true. And then I can just make this whatever dollar amount I want to exit, and that number I can optimize because it's not a formula. All right, while we're here, let's click on properties. So properties for all, this controls the cost of the cost to trade the strategy. I've put in $1.50. Actually, commissions are 0 for futures, but there are exchange fees that we have to pay. So here, those exchange fees are $1.50. It's service fees, whatever you want to call them. It's $1.50 per contract. We're trading 2 contracts, so that's $3 in and $3 out. That cost to trade is $6 per trade. Every time I make a trade, it's $6 comes out of the profit. Commissions are such a small part, though, of trading costs. What a lot of time is the bigger cost in trading is the slippage. When you're placing market orders, you're buying typically at the ask, you're selling at the bid. So that gap is the slippage that we want to factor into the strategy, just as a worst case scenario. So here I'm factoring in $12.50. And again, we're doing that because the E-mini has a $50 point value. It trades in 25-cent increments, so each minimum move is $12.50. I plug that in here. It's per share or per contract, so that multiplies times 2, so that is $25 per trade. And that's what we're doing here. Trade size is set over here on the right, and that is set to 2. Intra-bar order generation or look inside a bar backtesting doesn't come into play using case bars. You can't turn on intra-bar order generation with price-based charts like case bars. So I wouldn't do that anyway because I want the bar to form and close and verify my pattern before I make the trade. So backtesting doesn't matter here. We might want to test in phase 4 testing. So let's say phase 3 testing is adding some technical exits or experimenting with technical exits. Sometimes, one of these phases completely fail and you're back to phase 2 again. So phase 2 is still a good strategy. Phase 3 tries to improve that. Sometimes it doesn't improve it. We're back to phase 2. Now phase 4 might be scaling in. So if I get a key reversal, and I get another signal within a certain number of bars, I might want to take a second trade. So I take an initial trade of 2, and then maybe I take another trade of 2 in the same direction. Now I'm long 4. And then I'll exit that at some profit target or stop loss. We can test that. Anyway, that's the idea. All right, let's go back to PowerPoint and see what comes next. So the preliminary results here look pretty good. And so the next step would be to monitor this strategy in the simulator to make sure that it is generating orders the way we expect it to and that the performance is consistent with what we saw in the back test. But eventually, we have to test this strategy with real dollars. So what's great about this strategy, and there's a couple reasons why I picked the E-mini, by the way. So one of the reasons I picked the E-mini is that when I'm using a bracket profit target and stop loss and I'm trading a stock, the market can gap way up or way down against me, and I have no control of that. So even though I have a $1,000 stop loss, if I'm trading Nike in a strategy and Nike decides to gap up or down 10 points, I have no control over that. With a future, that overnight gap risk is really much lower because the market's only closed from 5 to 6 o'clock during the week, and then I might be more concerned over the weekend. I may not hold positions over the weekend. I certainly don't have overnight risk, or I don't have as much overnight risk using the future. So that's one of the reasons I like this. The other reason that I picked the E-mini for this strategy, I can trade the micro E-mini and test this strategy in a real world environment with real dollars with really small size. So the micro E-mini is 1/10 the contract of the ES, and it is the exact same data. So this whole strategy can scale down 1/10 the size and test it with real dollars, factoring in the commissions and factoring in the slippage cost, just to make sure that was all factored in correctly. So that's kind of the next step here. The other thing that I think you should think about, going through the same process that I just went through, but go through it on the short trades so that you can kind of develop these skills on looking at different scenarios, different inputs, different chart intervals, and kind of narrow it down the same way I narrowed it down with phase 1 testing and phase 2 testing, so that you can develop your own strategy. And because some symbols, it may be more appropriate to use short trades. Maybe you're looking at bonds, or you're looking at the dollar, or you're looking at other things that are trending down. You can use this strategy and develop it for those short trades just by going through that same process. So we were able to find a number of scenarios that had that 55 to 60% winning percentage that we were looking for. The risk-reward ratio got us to a positive expectation of profits. That's what we were looking for. And the optimization report was pretty stable. Most of the tests were positive, so that was all good. However, the strategy still has some issues. I don't like having 5 or 6 consecutive losing trades. It's very difficult to trade through for me. And so I may be looking for additional rules or exit conditions to try to reduce that. Sometimes you can't, and you have to live with it. The other thing I noticed on this strategy is that when you look at if you look at the equity curve of this strategy, the first third of the trades kind of just were meandering sideways. It was not making profits. And what that indicates to me is that maybe I'm looking at too much historical data. Maybe I should only be looking at 2 months of historical data, and every month maybe I go through this process again to make sure that I'm using the right inputs, I'm using the right intervals. And that is a very common way that strategy traders will trade and constantly be reviewing and tweaking their strategy over time, because the market does change, volatility does change. And so that equity curve was hinting that maybe I should only be looking at 2 months of data at a time. And so I might try that. I might wait a month, and I might look at 3 months, and then I might look at 2 months and see how those scenarios differ. They shouldn't differ too much, but they're going to be a little bit different. And then I might test both of those scenarios in the simulator moving forward and see which one holds up the best. So that's my strategy concepts paper for September, the Kase key reversal. If you're watching this video outside of Masterclass, you need to be a member of Masterclass to be able to download the actual PDF white paper, the custom easy language and workspaces that are demonstrated and provided here. But that's easy to do. You can sign up for a free 14-day trial of Masterclass. That gives you full access to all of the resources, including the white paper that I wrote last month in August. You can take any of the free courses, watch any of the videos, attend live sessions, and really take your experience with TradeStation to that next level. So just visit www.youcantrade.com and click on channels and click on Masterclass and discover how you can really improve your experience with TradeStation. Thanks again for watching, and I hope to see you in Masterclass.